volatility in U.S. rates is bound to increase. We've broken through some very important levels, as you say, in the 10-year Treasury yield. I think from an FX perspective, 10-year real rates actually tend to be more important than 10-year rates, and 10-year real rates are now well above 2%. And there's this sort of supply-demand headwind that there is for the U.S. Treasury market. So I think definitely volatility will remain high. The risk to rates is probably to the upside. We prefer positioning in the very front end than necessarily at the back end, because the back end, you have this dynamic. If you have a big risk off, a 10% equity sell-off, then it might constrain how much higher 10-year yields can go. But as I said, I think the bigger picture thing is that volatility in U.S. rates is going to increase over the next few weeks.
In terms of the requisite then impact on a number of these currencies, and I don't want to talk about the yen to the yuan or those kind of crosses. I want to talk vis-a-vis the US dollar, and I suppose it's almost a necessity for a number of these countries. And, according to some flashes that we're seeing right now, India is always in the same boat, but they've been ring-fencing, the rupee 81 to 83. But in terms of the intervening that has been going on in terms of selling down US treasuries, it almost creates a feedback loop in some respects, because that widens out the yield differentials potentially, considering there's no marginal buyers right now of US treasuries, and you could just see the intended consequences being very different from the actual consequences. So where do you see the yen? Where do you see the yuan? All these currencies, all these sovereigns that are trying to maintain some semblance of stability in their currencies, but at the same time there's a multitude of factors that are working against them right now.
Oh, absolutely. And I think the simplest factor is you're fighting against a strong dollar. I think what's a bit different about a lot of the Asian currencies this year compared to, say, 2022, when we also saw a lot of intervention, is that the dollar strength is kind of dominating everything. And the other difference is actually the volatility this year is meaningfully lower than it was back last year, say when the when the Ministry of Finance in Japan intervened back in September of 2022. So in that sense, I think it's a lot harder for central banks to kind of stand in the way of local currency depreciation. As you said, you have different central banks, engaging in different levels of activity. I think the PBOC is on kind of the extreme end of doing a lot to contain currency depreciation. But then you have obviously the question of whether the Ministry of Finance in Japan will intervene at some point. But ultimately, I think if the dollar continues to strengthen, the best option for them is to allow their local currencies to depreciate. The local currencies are not depreciating so much because of local reasons. I would argue a lot of the bearishness in China, for instance, is priced into the exchange rate, but it's weakening because of a stronger dollar, and therefore you should let it weaken. Otherwise, you face the consequences of tighter onshore liquidity and stronger trade-weighted exchange rates, which is the last thing you want when you're concerned about economic growth, especially for a country like China.